In this video, you're going to learn everything that you need to know about index funds and which index funds are great to create wealth. Investing in index funds is one of the most powerful ways you can build wealth passively. It's a no-brainer why most self-made millionaires use index funds as a way to build their fortune, and why people like Warren Buffett, the greatest investor of all time, advises people to avoid picking individual stocks and rather invest in index funds. So in this video, I'm going to walk you through the entire process, step by step, how exactly you can invest in index funds. We will start with the basics and tell you exactly what an index fund is. Before we jump into the video, it will mean a lot to me if you smash the like button and subscribe to the channel if you've not done that yet. With that out of the way, let's jump into the video. An index fund is a type of investment that tracks a specific stock market index, thus the name index fund. To put it in other words, a stock market index is a group of stocks that trade on the stock market. For example, one of the most popular stock market index is the S&P 500, which is an index that tracks the 500 largest publicly traded companies in the US. So any investor that has shares in this fund that tracks the S&P 500 index will essentially be tracking the performance of the 500 listed companies in this index. On the other hand, things are different for those who pick individual stocks. When you invest in an individual stock, you're pretty much buying shares in one company. For example, when you buy shares of the Amazon stock, you're pretty much investing in that one company. It's also very expensive for beginner investors buying individual stocks. On the contrary, when you buy shares of an index fund, you're not only just investing in one company. Instead, you're investing in one part of the stock market, which contains hundreds, even sometimes thousands of individual stocks. So this brings me to the first question. Why should you even bother to invest in index fund? For starters, when you invest in an index fund, you own a wide variety of stocks when you buy shares in that index fund, such as Vanguard Total Stock Market Fund. This index fund measures the investment return of the overall stock market, and so are the shares of Vanguard's S&P 500 fund, which tracks the S&P 500 index. And this is one of the largest funds on the market, with hundreds of billions in the fund. Here is the primary reason why you should invest in index funds: because they give your portfolio much greater diversification and lower your overall risk compared to investing in individual stocks. Now, when it comes to investing in index funds, 1. What things should you be looking for? In other words, how can you ensure that you're maximizing your investment returns over time? 2. What criteria should you be looking at when choosing your index fund? The first and perhaps the most important thing that you should look at is the expense ratio of the index fund that you're considering to invest in. The expense ratio is just how much money the fund takes off the top of your investment every year. If at all possible, you should always aim your expense ratio to be as low as possible. A rule of thumb is to seek index funds with an expense ratio below 0.05%. A good example of an index fund with a low expense ratio is the Vanguard Total Stock Market Index Fund with an average expense ratio of 0.04%. This means that you only have to pay $0.4 per year for every $1,000 that you invest. The next thing that you need to pay close attention to is to see that the index fund that you invested in mirrors the performance of the underlying index it is tracking. For example, if you check the returns of the Vanguard Total Stock Market Index Fund, you can see that this index fund's returns are identical to the underlying index that it is tracking. This is a good sign because it shows that the index fund is being managed properly. The third thing that you need to pay close attention to is to make sure that the index that you're investing in is indeed an index fund and not an ETF. This is so important because the two deal with dividend reinvesting very differently. When you invest in index funds, you have the option to automatically have your dividends reinvested for you, hence buying more shares of that index. But this is not the case with the exchange traded funds, which is the ETF. The exchange traded funds don't have this option. So with a few things out of the way, how do you actually start investing in index funds? Let's say, for example, you want to invest in Vanguard 500 index fund. The only way that you'll be able to invest in this index fund is if you have a Vanguard brokerage account. And the same thing applies to other index funds offered by other brokers. In some instances, some brokers do offer you the opportunity to invest in other index funds from outside brokers, but you need to have this in mind. For example, if you wanted to invest in Vanguard index funds through your Fidelity brokerage account, it will cost you a massive $75 per transaction. This transaction fee varies from broker to broker, but it is typically very high. But to be on a safer side, I would recommend to open up a brokerage account with a broker whose index fund you plan to invest in. So if you know and have have decided to invest in Vanguard Index Fund, then go ahead and open up a Vanguard brokerage account. And if it is Fidelity Index Fund, go ahead and open a Fidelity brokerage account. This now brings me to two very important questions, which are: what are the advantages of investing in index funds in comparison to picking individual stocks? And what are the best index funds to invest in? Let's first answer the first question. What are the advantages of investing in index funds? There are four main advantages of investing in index funds. The first advantage is that they have attractive returns. Index funds, like any other stock, do fluctuate, but overall, over time, indices have much solid returns, such as the S&P 500, which has a long-term record of about 10% annually. The second advantage of index fund is that they provide diversification. Investors like Warren Buffett like index funds because they offer immediate diversification. With just one purchase, you can own a wide range of companies. For example, one share of an index fund based on the S&P 500 provides you ownership in 500 solid companies in the US. The third advantage of investing in index fund is that they provide lower risk compared to conventional stock picking. Because they are diversified, investing in an index fund is a lower risk compared to owning a few individual stocks. Lastly, index funds charge a lower fee, hence the lower expense ratio as mentioned before. Now to our second question: which index funds are best to invest in? First and foremost, before I give you my opinion on which index funds are best to choose from, I want to be clear, I'm not a financial advisor. So I highly recommend that you check with a qualified financial advisor before you make any investment. Now, with that said, if your main reason for investing is for your retirement, then here are the best index funds to invest in based on your specific goals in terms of your portfolio allocation. You can allocate 70% of your portfolio to the US stock market index funds like the S&P 500, and the other 30% can be invested in other international index funds, which will give your portfolio a broad exposure to not only the US stock market, but also to the international stock market. This is because you don't want to put all your investment in one index, hence not putting all your eggs in one basket just in case. Second, if you're investing to create wealth and your risk appetite is high, then these are some of the best index funds to invest in. You have options of a mixture of growth index fund and small cap index funds from different brokers. You could allocate your portfolio as seen below in this example. 20% of your portfolio can be invested into a total stock market index fund, and another 40% being invested into a growth index fund, 20% being invested in a small cap index fund, and the remaining 20% being invested into an international index fund. By allocating your resources in your portfolio as seen earlier, hence investing your money in both growth and small cap index funds, while also including a broad market index fund and an international index fund, will provide you a wide exposure and diversification. Now that you know which index fund you want to invest in towards your financial goals, let's now move on to the next step of how you can buy an index fund. Because remember, index funds are not traded on the stock exchange, and so you can't buy and sell as you would do with stocks. Say for example, you want to diversify your portfolio by buying into index funds and have decided to start investing in Fidelity Index Fund. The first thing that you have to do is to open up a Fidelity brokerage account. The first thing that you'll have to go is to go online and then open up your broker's trade window and then click on the box as seen here, and you will change this to mutual funds, because an index fund is just a type of mutual fund. After that, you can go ahead and select which account you want to buy this index fund in. And then you will just type in the name of the index fund that you want to invest in, and then click the drop down that says action. And you go ahead and select that you want to buy this index fund. And then you enter the dollar amount. And then go ahead and preview. If everything looks good, then confirm it. And now you have officially invested in this index fund. My next video will be about the best index funds that you can invest in to get huge returns on your investment in 2023. So turn on the bell notification to be notified when we drop this video. If you got any value on this video, smash the like button. Also subscribe if you've not done that yet. Until next time, have a wonderful day. In the meantime, watch this video on my left on the 10 best investment options that you can consider to grow your wealth.